Welcome back, everyone. Hope you had a nice break. We're going to move on with our next presentation. Thanks again for joining us today. And if reminder, just if you do have any questions, please feel free to type those into the chat box and send those directly over to me. And then I'll let our speakers know of those questions. So just type those in the chat box and be glad to share this with our speakers. So let's go ahead and get things started with our next presenter. Our next presenter is Tom Nelson. He's the EVP, Chief Investment Officer, Management at Rich and Tang Deposit Solutions, and he'll be covering the summary of the FDIC broker deposit rule. Tom, turn it over to you.
Thank you very much, Glenn, and thank you everybody for joining us today. I hope you find this useful. Again, just if you have questions, please feel free to ask them. It's better that you hear what you need than what I think you need. As I go through this presentation, anytime you're talking about regulatory issues and specific rules and regs, it can get a little dry, it can get a little confusing. So, that especially, please, if I'm confusing at any point about some of these issues, please feel free to ask, and I can go over things again and make sure everybody understands. Here we go. 1 second here. So let me just start with a little information about Rich and Tang. Make sure you understand where the information you're getting is coming from. You can decide whether if there's any bias here, which I will do my best, obviously, not to. But this is a rule that's actually very near and dear to our heart. Very important to an awful lot of customers, both banks, broker dealers, as well as trust companies that we do business with. But Rich and Tang, we're now known as R&T. We rebranded ourselves recently. We're a leader in the FDIC insured sweep space. We provide cash management solutions to pretty much all types of financial institutions, from banks, credit unions, trust departments, trust companies, broker dealers, and on and on. We have more than $100 billion in deposits under administration. We've been in this business of cash since 1974. In fact, if you had asked this question, 30 years ago, I would have said we had the fourth oldest money fund in the industry. We're now no longer in the money fund space, focusing solely on FDIC deposits. But we've been in the cash space for an awful lot of years, understand the needs of pretty much all participants in the cash space. And we provide banks with the ability to have a strategic on-balance sheet, off-balance sheet liquidity management program. Through many of our products, banks can help their improve their own balance sheet needs. We try to be a thought leader and an educator on reciprocal deposits and other legislation. Senate Bill 2155, the paper bill, is something that we continue to try to educate about, and we feel it's our mission here and our responsibility to talk to customers and individuals like yourselves that may or may not be customers about the implication of some of the regulatory changes that are going on in the market. So with that, I will end the commercial part of the presentation and move into the facts. So we're here to talk about the broker deposit rules that were announced by the FDIC on the 15th of December, subsequently fully published in towards the end of January of this year. And while it doesn't fundamentally change the existence of broker deposits, it really does change the definition in some instances of what is a broker deposit. Whether somebody is or is not a deposit broker, it sets forth exclusions from the rules, and it's intended to set up a it sets a single set of rules for what is and isn't a deposit broker. One of the issues that we've had in the industry over the past number of years is that a lot of different participants are working off of opinions and interim statements made by lawyers, FDIC, et cetera, et cetera. The goal of this is to wipe the slate clean, set up a new framework for what is and what is not a deposit broker. And I think it does a fairly good job. And as we'll talk about later on, what it's going to do is have a period of time where we go from our existing structure, relying on certain rules and interpretations that are in place, to this new structure over the course of about 9 months. So an interim period where people will be able to rely on both. But clearly what we want to talk about today is some of the changes in the deposit of what, I'm sorry, in the definition of what is a deposit broker. So under this rule, under what we'll describe as the final rule, a deposit broker includes any of these following items: a person that's engaged in the business of placing deposits of third parties with IDIs. IDIs, as I'm sure you're well aware, are a fancy way of saying thanks. You know, and the second point is a person that's engaged in the business of facilitating the placement of deposits. Now, the difference between A and B, 1 and 2, is somewhat important as we go through, because there are a number of ways that a person that controls deposits, somebody that's in the business of placing deposits, can get a primary purpose exemption. And there are specific things that an entity that facilitates the placement of deposits has to do in order to be considered a deposit broker. So the delineation between 1 and 2 really is important. And as I'm talking today, I'm really going to focus on 1 and 2. 3 and 4, while important, depending upon the specific situation, it's 1 and 2 that represent kind of a potential watershed change for a number of banks and for the market in general, and will create an environment where a large number of banks can now access very, very significant amounts of what I will call wholesale core deposits. What I mean by wholesale is obviously deposits not through your traditional branch network or traditional banking network, but from third parties, but are from entities which the FDIC will now consider core, which in most cases were previously considered brokered. I think this is very important because we're now talking about the possibility of literally hundreds of billions of dollars of deposits that are available to banks on a core basis, as opposed to a brokered basis. So any bank that has a situation where they have shied away from brokered deposits in the past, not because of pricing or other reasons, but because of regulatory issues associated with how much they have in brokered deposits. Obviously, a lot of firms that are at or above 10% or near 10% consider it a very difficult position to add more brokered deposits. A lot of firms, for regulatory or internal reasons, don't want brokered deposits, period. That all changes with these rules because there are now significant ways of getting wholesale deposits. So the final rule clarifies that a person is engaged in the business of placing deposits only if they do the 2 following things. 1, they have to have a business relationship with the third party. So an entity must have some type of a business relationship with the ultimate owner of the funds to be considered, possibly considered to be engaging in the business of placing deposits. Secondly, that entity must receive those funds and then pass them on to an insured depository bank. So it's not good enough to just have a relationship. It's not good enough just to receive funds. It has to have both of those in order to be considered somebody that engages in the business of placing deposits. And somebody that engages in the business of placing deposits is, by definition, a broker under these new rules, with certain exceptions that I will go into in a minute. One of the key things, and obviously one of the big changes in the markets over the past number of years, is the increase of financial technology firms. You know, I'm sure we're all aware of all the different firms that are kind of acting like a bank, shall we say. but really aren't banks, but are attracting deposits and passing those deposits along to another bank. To a bank, excuse me. One of the things that's very clear in this rule is that if there is an exclusive arrangement between a financial technology company that is providing the ability for customers to have, access to things like, mobile banking and things like that, and all of their deposits are going on to a single bank in some type of an exclusive depository agreement, that entity is not considered to be a broker-dealer. I'm sorry, a deposit broker. So if you have a fintech company that has an arrangement with Bank XYZ, and every dollar that comes into the network of that broker, fintech company, excuse me, and every dollar is then passed along to a specific bank in some type of an exclusive arrangement, the fintech company, by definition, under this rule, is not to be considered a broker, a deposit broker. It's very important, especially for banks that are dealing with fintech companies. It's a very important issue. I'm not going to spend a lot of time talking about that because the number of banks that it impacts is not that significant relative to some of the other parts of the rule. The second thing we talked about there was the business of facilitating the placement of deposits. If somebody facilitates the placement of deposits, they would be considered to be a deposit broker. Now, in order to be considered to be someone who facilitates the placement of deposits, there are three things that to be exempt from being considered a facilitator. Somebody can't do any of these three things. One, they can't have the ability to legally open or close an account. Any situation like that, they'll be deemed to be a deposit broker. They don't have the power to negotiate. They don't set rates, they don't set terms, they don't set fees, they don't set conditions of the deposit accounts, anything of that nature. And they're not acting in matchmaking services. Now, matchmaking services is a new term that had never been used by the FDIC until this rule came into being. I will go into what is defined as a matchmaker as we go along, but anybody that you're doing business with who does one of these three things, can close an account, open an account, has the ability to negotiate or provides matchmaking services, you will have to consider them a deposit broker. But if they don't behave in any of those manners, they will be exempt from being considered to be a deposit broker. So, under this facilitation prong, I just want to go through the three things. Opening and closing an account is pretty clear. If you have the ability to close an account on behalf of your clients, you're a deposit broker because you're facilitating. But also, if you have the ability to move deposits to another bank, you are also considered to be a deposit broker. So whether I have the ability to open or close accounts is not the only test here. If I have the ability to move money for some or all of my customers from bank A to bank B, whether it's because of rate, whether it's because of whatever purpose, again, I have that ability. I am going to be considered a deposit. Negotiating rates, fees, terms, conditions. This is the critical, I think, the critical issue as it pertains to the biggest market we're going to talk about, which is broker-dealer as well as trust and other sweep vehicles. The question will ultimately become who is providing these rate negotiation, term negotiation functions as these deposits get set up. If an intermediary, and this is one of the businesses that we are, as a firm at R&T, very, very heavily involved in, we're an administrator for a series of broker-dealer sweep programs. These are programs where people have a brokerage account at a firm, they own stocks, they own bonds, and the cash is more often than not swept into some type of an FDIC-insured vehicle. Really, an FDIC-insured program is a better description than vehicle. In most cases, somebody like us is administering the program, allocating specific accounts on a daily basis, you know, and doing an awful lot of work from a contracting, rate negotiation perspective. To the extent that we continue to do those types of things for a specific bank in connection with a specific broker-dealer, we would have the same issues here, where we would be considered to be a deposit broker. But what the final rule makes very clear is that certain activities, you know, market research, general consulting, advisory services, advertising, et cetera, are not part of the facilitation prong. This will be important as I talk about ways going forward that banks will be able to access this market in a core fashion, where historically they've only been able to access this market in a brokered fashion. Now, the final part of that facilitating deposits prong has to do with something called matchmaking. There's a full description here of what exactly matchmaking is, but in essence, what matchmaking is the following. If I know the needs of a bank that can take deposits from my customers, I know the needs of my customers as far as types of banks and relationships that they're looking to have, and I then propose or create a deposit allocation structure based upon that knowledge, I'm behaving as a matchmaker. So I'm basically saying I'm going to go to Bank A, find out what they need, go to Bank B, find out what they need, go to Bank C, find out what they need, and then do the same thing on the other side with depositors, and put those two together appropriately to meet the needs of both sides. If I provide those kinds of services, where in essence I have flexibility to determine how much money goes to one place or to one bank versus how much money goes to another bank, I'm behaving as a matchmaker. I will be considered to be a deposit broker under this new rules. Now, I mentioned broker-dealer sweep program. This is, you know, where matchmaking really becomes an issue. If we look at the way that we do business today, much of what we do could be considered matchmaking because we have control over where deposits ultimately end up. But we need to distinguish in a forward basis between whether we are doing those services or just providing administrative services. And proposing deposit allocations is one of the big issues there. If we talk to one of our customers, one of our broker-dealers, one of our trust companies, and propose deposit allocations based upon the knowledge we have about the needs of Bank A, Bank B, Bank C, Bank D, those banks should consider us as a deposit broker. But if we don't provide those services, if we don't propose deposit allocations, but are simply acting on the direction of the broker-dealer as to where to place its customers' funds, then we're providing only administrative services. There is you know, in the supplementary information about the rule, there is a robust discussion about active versus passive. In other words, what am I doing as a facilitator to affect where money goes versus am I just taking direction from the parties who are my customers on both sides. This would also another significant place this would impact would be listing services, where clearly they're not, they're acting in a passive manner. They're providing information to both sides, but they're not negotiating rates. They're not directing funds. They're not, forcing money to move from one place to another based upon their information. They're simply providing a passive information source. That becomes very important. Now, those were the issues around how somebody could be considered to be a facilitator of placing deposits. The other issue is somebody who's in the business of actually placing deposits. This notion primarily impacts different types of asset custodians, whether that's a broker-dealer, a bank trust department, a trust company, a custodian, in some cases, a registered investment advisor, although usually a registered investment advisor would have their accounts held at one of the other entities. And what this rule says is that if one of these entities is placing deposits into IDIs, into banks on behalf of its customers, but those deposits represent less than 25% of their assets under administration, they will be exempt from being considered a deposit broker. So broker-dealer XYZ, Merrill Lynch, Wells Fargo, LPL, Raymond James, pick a name. If the accounts that they have less than 25% of the assets in those accounts are going to IDIs, then they can say to the FDIC, we should be exempt. The rationale there is that the FDIC is saying that their placement of deposits on behalf of these customers at banks around the country is ancillary to their primary purpose of business. And it gives them the ability to notify the FDIC that it wants to make use of a primary purpose exception. In other words, their primary purpose is to serve the investment needs of their clients, not to place deposits at FDIC banks around the country. Now, for banks to calculate this number, for broker-dealers or any custodian to calculate this number, it's really very simple. The denominator is going to be all of the assets, stocks, bonds, mutual funds, cash, everything that they are holding on behalf of customers. The numerator is just going to be the amount they place at IDIs. But importantly, that number that they place at IDIs is only the amount in non-brokered structures. So if they have brokered CDs, those brokered CDs would be a discrete business line and not part of the calculation. And it would also, it's very clearly defined that brokered CDs do not qualify for any of the primary purpose exception. So almost any broker-dealer, almost any custodian, almost any trust department, trust company, etc., is going to qualify for this. It's very unusual for any of those entities to have more than 25% of their assets under administration in cash. So what does this mean? This means that every broker-dealer who has a sweep program now is somebody who can potentially provide core deposits to every bank around the country. Why is this important? Well, because it's $1 trillion business. This is not, some small rinky-dink dollar volume. There's more than $1 trillion in broker-dealer sweeps. A lot of that money does in fact go to banks that are part of the family of a major broker-dealer, AKA a Wells Fargo, a Charles Schwab, a Merrill Lynch going to Bank of America, a lot of this money is in situations where the home bank, the parent bank, the associated bank, whatever term you want to use, is getting those funds. But there is literally hundreds and hundreds of billions of dollars in situations where deposits are going from a broker-dealer that does not have a bank and is going to third-party banks. With these rules changes, it's our opinion that these deposits are now fair game to banks as being core deposits. And that's where we see this being really a game changer. Now, one of the other issues is about, so the 25% rule is that I just discussed a little bit. That's one of the ways that somebody who places deposits can get a primary purpose exemption. The second is an enabling transaction test. These are business relationships where 100% of depositor funds are going into transactional accounts. They don't pay any interest. They don't pay any fees. These are situations, for instance, prepaid cards. You buy I don't know, Best Buy gift card, anything like that, or you get a tax refund from H&R Block on a prepaid Visa card. All of that money sits somewhere, doesn't pay interest. Any of those types of situations, the person placing those funds, the entity placing those funds with banks, can use the enabling transactions test to say, I'm not a deposit broker. It's a very targeted rule, and it's directed really towards those types of entities. Now, whichever direction a institution wants to go to get an exemption from being considered a deposit broker, they have to file a notification. There's a notification process with the FDIC. This is different than what we had originally anticipated would be in the rule, in that we expected the rule to be more of an application process as opposed to a notification process. But under the rules, let's use broker-dealers or trust companies as an example. All they need to do is notify the FDIC that they qualify for the primary purpose exemption and can be exempt from the being deemed to be a deposit broker. The FDIC has indicated that either that institution itself can provide notice to the FDIC, or one of the IDIs involved with that institution can provide that information on their behalf. Our expectation is that it will be probably very unusual that a bank is going to go to the FDIC to say organization X from whom they're getting deposits should not be considered to be a deposit broker. We expect that originating organization to almost exclusively be the ones to do that. This will be in their interests to do. It's obviously in the bank's interest to do, because they'll get a core instead of brokered funds. But if it's in the interest of the banks, it's more attractive to the banks. The originating institution will have better access to capacity, to a variety of banks, and potentially possibly to rate, because banks will consider these deposits more valuable than they would have had they been brokered. The FDIC has made it pretty clear in the rule that the notification process will be immediate. So there will be an electronic process that has not yet been set up, that will be set up by April 1st is the expectation, where one of these entities can go in, provide the appropriate information, and they will get immediate acknowledgement from the FDIC that they are not, that they have qualified for the primary purpose exemption. As time goes on and as examinations of IDIs and others go through, the FDIC can request more information if it feels it's necessary. But the original assumption is that these banks, that these custodians, broker-dealers, trust companies are in fact exempt from being a deposit broker. You just have to be prepared that if the FDIC asks for something down the road, that you're able to get that information. The FDIC also has the ability to revoke the primary purpose exemption with notice if it feels that the notification for primary purpose exemption has been made, shall we say, on shaky grounds. That information has not been relayed fully accurately, and I'll run into some of the reasons why that could happen. But we expect that that is going to be a very rare situation. What does one of these entities need to provide to the FDIC? They're going to have to select which of the exceptions they're looking at, enabling transaction or third part or 25%. They're going to have to give a brief description of the business line. The business line becomes important to make sure that they're looking at the business line in a proper way. For the 25% exemption, which is where we expect the vast majority of the impact to be here, they're going to have to tell the FDIC what their total customer assets under administration are, what the total placed in third-party banks is, to come up with the backup data to why they have less than 25%. They're going to also have to tell the FDIC if there's a third party involved. So again, in the case of a broker-dealer sweep or a trust company sweep program, if somebody like R&T is providing services, they're going to have to tell the FDIC that A, we're involved, that there's nobody else other than us involved, and a description of what we're doing. And then they're also going to have to, to the extent that an IDI, a bank, files this information on behalf of a broker-dealer, they're going to have to also list the other banks that are currently receiving deposits through the program. That's one of the reasons we expect that this will rarely be done by a bank and is almost exclusively going to be done by the broker-dealer, trust company, custodian. On an ongoing basis, the entity that filed for this primary purpose exemption is going to have to continually update the FDIC with new information. 25% exception, they're just going to have to refile what are their new assets under administration, what is their new cash number, and that's it. For enabling transaction notices, they're going to have to do a certification that everything's changed. They continue to place customer funds in transaction accounts pursuant to the primary purpose exemption rules that the FDIC has put in place. And revocation, they can revoke this to the extent that the third party no longer meets the criteria, that they realize that some of the reporting has been accurate, or, and this is more of a technical issue, that the third party just fails to provide quarterly required reports. Probably not going to be an issue in many cases. So as we look at this, and this is ultimately where I think that the criticality is for banks. There are now going to be situations where banks look at broker-dealer sweep programs, custody department sweep programs, independent trust company sweep programs, etc., and say to themselves, can I work with these units? Can I work with these entities and get funding in a core versus a brokered manner? And on the left-hand side is a situation where there is no third party involved. A a broker-dealer or a custodian or a trust company simply works with multiple IDIs and placing funds. In that situation, as long as that originating broker-dealer, and again, anytime I say broker-dealer, I really mean custodian, broker-dealer, trust department, trust company. I just don't want to keep repeating all of the options. As long as that broker-dealer has said and filed notice with the FDIC that they are exempt from the primary purpose, or that they're subject to a primary purpose exemption because of the 25%. If they have that information, they'll be able to provide it to you. It's very clear they will be able to treat this. I'm sorry, the banks, you guys, the IDIs will be able to treat this as a core deposit. Big change from where we are today, where by definition, every one of those broker-dealers, it didn't matter if we were involved, it didn't matter what we did. Those broker-dealers were deemed to be deposit brokers. There was never a conversation to be had here. The second way, on the left-hand side, to us, very clear, no issues, those will be core deposits. Second issue is where the structure looks fundamentally the same, except there's somebody in the middle, like an RNT, who is administering the sweep, allocating all the underlying client balances, potentially negotiating rates, potentially doing other things. In that case, where the broker-dealer's already filed the primary purpose exemption and has identified us as being involved, the bank is going to have to make an independent analysis, an independent confirmation. Does the sweep administrator, does RNT make this a brokered deposit because of the things that it's doing? So this is where we go back to the original conversations that we had before. The broker-dealer is going to file the exemption. They're clearly not going to be a deposit broker. The sweep administrator, you have to ask the questions about whether or not the sweep administrator is, quote, facilitating your deposits. Can they place deposits? No, they're not placing deposits. Can they? That would only be the broker-dealer. Can they close accounts and move funds? No. In all those situations, the broker-dealer, it's a custodian that's actually moving the money. The money isn't. The administrator is never touched the money. Does the sweep administrator negotiate rates? That's where the real issue is going to come down. Are you calling RNT as an example and saying, I need X dollars at X rate, can you get it for me? We say yes. If that's the way this goes for a specific bank, it'll be a deposit that we will be considered to be a deposit broker. The deposits that are created out of that transaction would be considered to be broker deposits. If, however, the bank negotiates directly with the broker-dealer, custodian, trust company, Rich and Tang will not be setting rates, negotiating terms, etc. We will not be matchmaking because the broker-dealer will be telling us where to place deposits. We will not be telling them where to place deposits. So you will have, and this is one of the critical things. Right now, if you look at all of these sweep programs, pre-April 1, today, they are by definition broker deposits because the broker themselves, the broker dealer, is going to be considered a deposit broker, no matter what else happens. Going forward, every broker dealer will have the ability to get an exemption. You have to look at then the sweep administrator. Are we setting rates? We view the future of this world to be somewhat of a situation where the broker dealer is going to be establishing rates and terms directly with banks and not with people such as RNT in the future, because banks are going to want to get these as core deposits. Now, in addition to what we talked about a notification process, the FDIC has also laid out the terms for an application process. So if a third party believes that they fundamentally are not brokering deposits, that they're, behaving in such a way as one of the exemptions, and they feel like they can make an application to the FDIC so that they would be treated under this, with a primary purpose exemption, they can make that application to the FDIC. The FDIC will give up within 45 days, will provide that entity with the information that it needs to complete the application. And the FDIC will make a determination within 120 days of whether or not they will be granted primary purpose exception. One of the things that we had expected originally in this rule is that would be the process for every broker-dealer, every custodian going forward. It isn't. It's a notification process for the vast majority. I don't expect that there's going to be very much success by very many entities that will be able to use the application process, but there's always somebody who, for some technical reason, fails, but really behaves in a way that the FDIC would not be considered to be a broker. This gives them some recourse to getting the same treatment that a broker-dealer or a trust company would. Now, one of the other issues here is not only the issue purely of brokered versus core, but the issue of adequately capitalized and what's the impact on these deposits. Well, first of all, if a deposit is not considered to be a deposit, the whole issue of adequately capitalized and whatnot goes out the window as far as being forced to return deposits. Under Section 29, the section talking about the broker deposits, an adequately capitalized bank can accept, renew, or roll over any broker deposits. So if you have a 3-year CD, it'll stay on the books, but when that matures, if you're still adequately capitalized, you can't reissue it, you can't roll it over, you can't renew it. And slowly but surely, your brokered quote unquote book will go to zero. One of the big issues there had been, what about non-maturity accounts? And technically, there had been positions taken by the FDIC that a non-maturity account was in essence an overnight transaction and had to be, closed as quickly as practicable. What has changed here is with a non-maturity broker deposit. So even if you go the route of doing business with a broker dealer in such a way that that deposit's going to be considered brokered, if you become adequately capitalized, you do not have to get rid of that deposit immediately. What you can't do is increase the size or balances of deposits you have with that entity. So you do $10 million with broker dealer XYZ. You fall to adequately capitalized. You can't do $10 million in $1. You can only do the $10 million that you had the day that you became adequately capitalized. And for any type of an agency account, which is again what a broker dealer structure is going to be, anything that for benefit of, for the any kind of for benefit of type of account. No new customers within the nominee account can be added in. So a broker dealer who has 100,000 ultimate customers, if there are 30,000 of those customers allocated to your bank when you become adequately capitalized, that becomes a universe. 30,000 customers are the only customers that can be allocated to your bank going forward. The other 70,000 who weren't allocated cannot be allocated going forward. Not a big deal to banks, but it does change the fact that now non-maturity accounts do not fit into the category of I got to get rid of them tomorrow if I become adequately capitalized. So it's certainly a benefit from any type of ALCO, risk management, contingency funding, regulatory purpose, that these deposits do not disappear the second that you fall adequately capitalized. This is just a description of that. Now, one of the things I talked about before is business lines. So any entity that goes to the FDIC and makes a certification for a primary purpose exemption based upon 25% exemption of less than 25% of cash has to do that at a business line. So if you take a big firm, you can't cherry pick balances from all these different organizations to, get to less than 25. So an example of that might be a bank holding company that has a broker dealer operation, a trust company, and then some kind of a deposit placement structure. You can't add up all the money from all the other areas and then throw in this other business line, which really walks and talks like a duck, so should be treated like a duck. And say, hey, we're under 25%, so everything's good. It's the business line where you have to make this determination. So you have to make a good faith determination that when you're making this application and when you're dealing with somebody who's made this application, that they're using the business line discussion appropriately. The FDIC has made a clear opinion, it would agree with this. They're going to scrutinize the identification of a business line, very closely, and they're going to be able to tell when people are cherry picking. Don't see this as an issue, but it is something to be careful of going forward. Because one of the issues that is going to be required is if an IDI has knowledge, and it's important to say that an IDI has knowledge that a determination has not been made in good faith, they have a responsibility to report. So here's just a kind of a chart, of the organizations within a large company, and using the core broker dealer and advised IRAs as a way to make private wealth who should not be a primary purpose exemption candidate, make them a primary purpose exemption candidate by adding in the other things. Our feeling is it's going to be very clear that this is the kind of situation the broker dealer would be exempt, the advised IRAs would be exempt, but the private wealth, which is going to be a completely different organization, a completely different business line, will not be able to get that type of an exemption. This is the kind of thing that I think will be important for banks that have multiple third-party relationships, whether it's through their wealth management, custody, and other businesses. They have to be careful about how they lump those together to try to get the 25% exemption. And here's the key thing. So when a bank needs to scrutinize everybody that's involved in the placement of a deposit. It's not just a person, this goes back to the original issue of facilitating as well as placing deposits. They've got to look at all of these other entities that could be involved. Does a listing service provide either matchmaking, rate setting, things of that nature? Does a listing service do that? No, fine. Does a custodian do that? No, fine. Every other organization, you just have to look and answer those questions for yourself. In essence, and the big thing is, does a third party decide how much money I get? Does a third party set the rates? Does a third party have the ability to open and close the account? Anybody you're dealing with, if you have to answer those questions, and if you can answer those questions no, that entity will be deemed to be will not be deemed to be a deposit broker. And where that becomes important is that this is a determination that the bank makes. It's not a determination that the broker dealer makes, it's a determination that the bank makes. I know I'm running short on time, so I just wanted to get to a couple of other things. Effective dates. So the rule goes into effect April 1st, which really means it goes into effect June 30th, because the big date here is when banks can file information with the FDIC on their call reports as to whether a deposit is core or broker. Doesn't matter what you did on April 30th, it matters what you do on June. There's a getting compliance period until January 1st of 22. What that means is that you can either use existing guidance on why you're doing what you're doing, or you can use the new rule. So you got the best of both worlds between between April 1st and January 1st. But as of January 1st, everything sunsets except for this rule. So any opinion, rule, interim rule, anything like that that's come from the FDIC or anybody else, that all sunsets. And this becomes the law, complete and only law of the land as it pertains to broker deposits as of January 1. Now, I want to highlight specifically, we talked about this, I want to highlight very clearly that for banks that have relationship with trust companies, with trust departments, this is now a huge new potential source of deposits that can be treated in a core manner. Any deposits like this previously where a trust department was providing deposits to a third-party bank would have been considered brokered under any circumstances. Now, these entities will be able to file a primary purpose exception and will have the ability to provide core deposits to a bank. You know, I didn't get a chance to go into some of the issues about it, exclusive IDI, but clearly, if a bank owns a trust department, if it's within the bank, there are a series of ways that they can get exemption from these being treated as broker. If they own a trust company, there are a series of ways. Or if they're working with an independent trust companies, there's a series of ways. So this is going to be very important. We've worked with a lot of banks in the past who have been concerned that if they took deposits from an owned trust company as opposed to a trust department of the bank, that they would have to be considered brokered because they're, for all the reasons they might be considered brokered. There are multiple ways now that these can be considered core. I think for a lot of banks that are dealing in-house with deposits, this is very important. And it's also very important for out-of-house. Investment pools, I think this is one of the areas where it's potentially problematic. Does an investment pool, can they be considered to be not a deposit broker going forward? It's not promising in our opinion. If they don't qualify for the 25% test, if you look at where their deposits are, it's going to be hard in most cases for them to qualify for that. So that's something to be aware of, that for investment pools, it's going to be a lot harder to get core treatment than it was going forward, but we consider that to be a small part of the market. Other issues, which I just don't have time to go in there, the FDIC has basically punted on interest rate restrictions and assessment issues. We assume that they'll do something at some point in the coming period. So that's where we are. I think, the big takeaway I would recommend you guys come away from this with is there is now a massive new source of deposits that banks can treat as core if they do business right. Then they could treat as that had to be treated as brokered in the past. And again, this is not a couple of $100 million. This is hundreds and hundreds of billions of dollars, way larger than the size of the brokered CD market in total deposit capability. So with that, I'll stop. Glenn, I don't know if you've got any questions or if anybody has any questions. Happy to take any questions if you do have.
Thank you very much, Tom. It doesn't look like we have any questions at this time, but as Tom mentioned, please feel free to reach out to Tom himself or to me, and we can make that connection. So I just want to thank you again, Tom, for a great presentation. Thank you very much.
Thank you very much for having me.
Great. Thank you.